Good evening, traders. It is Thursday, September 18th. Taking a look at the charts, overall, pretty nice day. Yesterday, we highlighted how the market was primed and ready for another pop and run higher. We just need to give it time to work itself out. The underlying trend is up, and we saw a nice pop higher today. The NASDAQ up about 1%. The small caps up 2.25% or 2.5%, and the micro caps up over 3.3%. So definitely money moving into the risky risk-on stocks, people wanting to take on risk and moving forward. If we look at the 30-minute chart of the S&P 500, the SPY ETF, you can see this upside target here based on this nice bull flag pattern that's formed over yesterday's sell-off and today's. We'll just kind of look at the price action here. You can see the upside target here for the S&P 500 rally from where it closed yesterday. We could see it move up about 1.5%. Now, this is obviously a 30-minute intraday chart. So this is a nice little bull flag pattern pointing to higher pricing. And overall, this chart pattern here is primed and ready for a continuation move to the upside going forward. Now, the NASDAQ, pretty much the same thing. If we take a look at that chart, you can see a big pop today. It's flagged sideways, and it is pointing to roughly a 2% gain over the next potential 1 or 2 trading sessions. So Friday, tomorrow is triple witching day for options. Expect a lot of volatility. It could really drag the markets down. It could make them go higher. I'm not sure. It is definitely an uncertain type of day, and just expect lots of volatility, lots of volume as the options market kind of manipulates things to try to make the majority of options expire worthless. It's just the markets are designed, they're very efficient to hurt the most amount of people. And there's 3 types of options kind of more or less expiring as triple witch. And so there's going to be a lot of pain on the street tomorrow when a lot of people's dreams of these options expiring in the money don't play out and they expire worthless. If we take a look at the hot list, the biggest gainers today were the MJ, which is the harvest or the marijuana sector, up over 4%. If we take a look at that, you can see it's been on a tear, huge tear recently. Percentage-wise, it may not look like much, but it is huge. If we take a look at semiconductors, Intel up big today, driving this up dramatically. Another big gainer, really helping juice the indices like the NASDAQ higher today. Biggest loser, COPEX and the XLP consumer staples. So we saw the copper miners pull back and consumer staples. Now, overall, they're down very little. It's not like they got hit hard. It's just money wasn't that interested in those 2 spaces, and a little bit of profits coming out of there. If we take a look at the chart of bonds, we did see TLT, long-term treasury bonds, pull back today. We talked about this the other day. I would buy on the rumor, everybody anticipating the rate cut, sell on the news. So money moving into risky stocks today and people coming out of bonds. Now that the news is out, they want to get out of boring bonds, move into the high-risk, high-potential stocks. When we take a look over the dollar, I drew this morning for members, but more or less the dollar index looks like it's trying to put in 3 surges to a low. It's put in a new multi-year low here this week. Overall, looking like it's trying to carve out a bottom. That it has not yet, though. But we did see a strong bounce the last 2 days and strong bounce today in the dollar. And of course, that is putting some pressure on gold and silver and miners. So we did see gold pull back today. About 1%. We saw silver pull back. Actually, silver closed positive today, slightly positive, depending on if you're looking at futures or the ETF. The ETF closed up 0.5% today, just on based on timing where it opens and closes. But we saw silver move up today. If we look at gold miners and silver miners, they all move slightly lower, kind of fizzling out here. Silver miner juniors, lots of volatility, closed down slightly a bit. Again, money moving out of bonds, out of precious metals, and going into the more risky stocks looking for more upside potential. If we take a look over at crude oil, it has been trending lower for several months. In fact, you could say probably several years. But overall, it really has had that reaction bounce up we talked about a couple days ago. It's kind of like a little hook. It pops up and then fizzles out. We saw that over here. Happens quite frequently. Overall, still the pattern is bearish. Sell off, pause, sell off, pause, sell off, pause. And the overall, all the moving averages are pretty much sloping down. So I wouldn't be surprised if more selling continues It's just struggling to, sellers are in control of oil and continue to have it pushing lower. Now, one of the members, Jay Murray, mentioned today, wanted to touch on semiconductors. So I want to touch on that real quick. Obviously, good news, big pop in semiconductors in that space with Intel. A very strong chart pattern. Semiconductors have kind of been the leaders. They kind of rally first, or they lead the pack, and they're first to reverse and roll over. So the trend is clearly still to the upside, but we're keeping our eyes obviously on semiconductors. Also on the Magnificent 7. If we look at the MAGS ETF, these are the powerhouses that really drive the market as well. And of course, the trends are very strong and moving up. So we'll keep our eyes on those. They give us some insight, but again, when they're trending up, they're going to drag the major indices higher with them. So yesterday we had locked in some gains, or actually a couple days ago, locked in some gains on our ETF positions on the indices just to reduce some exposure and move our stops up. More or less, we're getting to a risky time where this market could roll over with the Fed, and we were right at a target. We got out at the open a couple days ago on the gap higher, and then we had the Fed news come out here. Now, the scenario we have unfolding here, just grab this tool. The scenario we have unfolding here is very similar to what we saw back over here just before the tariff crash. So we have some very mixed signals. We need to be cautious, and my opinions on here are generally very bearish. I'm always talking about how this market could go into a huge sell-off at any point, and I don't want to really flip the script. The problem is when I talk bearish of the long-term picture, everybody seems to throw everything out, the baby out with the bathwater, and they become bearish and they bet against the market expecting it to fall. Yet, we'll be long the market like we have been since way over here, playing the upside, even though I'm bearish. So I kind of want to flip the script. I mentioned this the other day as well, that I'm focusing more so, instead of talking really bearish, let's act like we're a 16-year-old here, like my daughter, who's about to go for a driver's license and take defensive driving lessons, where we need to check the mirrors, we need to know what's going on around us and be defensive with our positions. And that's what we did with a recent trade here, reducing our exposure just before the Fed came out, because we were pennies underneath our target up for the ETFs. And so it's best just to lock in those gains than risk it on news and wipe out a good chunk of our gains if it backfired. So the market has rebounded. It looks like it wants to still go higher, but that's what we're doing, is protecting ourselves, because at any point we could see this market go off a cliff and crash. Just because it could happen, and I think it's going to happen soon, doesn't mean we actually trade in that direction. So follow price. Don't follow my opinions and thoughts and scary outlooks. You just have to follow price, but you need to know that eventually one of these things is going to happen, and it's good to be mentally prepared and to make sure you don't hold on to losers, because you don't want to hold on to something that goes down 5, 6, 7%, then find out it falls another 15, 20% or more from there, and then you end up taking a big loss. When the trend reverses, we don't know if it is going to be a tiny little 3% pullback and get back into an uptrend, or if it is going to be a huge 20 plus or correction. So we must be defensive, protect our capital going forward. And this member, Sammy, shared a story today talking about how they have a niece, I think it was, who was driving a car, scratched something in a parking lot, drove away, scratched another car. They ended up going to the police with their parent and said, hey, listen, this happened. They did get in some serious trouble still for fleeing the scene. And they were sharing it because I'm talking about how we need to be defensive. We need to follow rules as traders. If we don't follow rules when the trade ends, or when we're stopped out, or the trend ends and we exit, you can end up getting into a lot of trouble, big losses. If you flee the scene in life of an accident, obviously you could have some serious felonies and fines with that. So we need to follow the rules. The story here is stick to rules, follow the rules, and make sure you protect your capital, number one. Now, overall, we have a lot of positions in the money. We've locked in gains on almost every position we have. We're long the SPY. We are long QQQ. With our other strategy, we are long SSO, which is the double two leveraged S&P 500. It's up about over 5%. We have QLD position, which is up over 6.5% from our entry. We are up on long XLC, which is the communication sector space. This one is up 9 This one is up 9.14% from our entry price. We have closed out our IBIT ETF for a win. We closed out our SILJ, which we actually just looked at SILJ. It hit our 20% max target, and we closed out right up here a few days ago. So overall, we're sitting pretty. We are long gold with PHYS. It's up. We've locked in partial profits on this recently. We're up about 5% on that trade, also expecting gold to continue to move higher. So overall, the trends continue to be up. Even though I am bearish and worried that something bad is going to happen, it doesn't affect our trading. That's what people need to understand. Let's follow price. Let's trade the markets. Let's not trade fear. Let's not trade emotions and opinions. Now, when we look at our TTI, our technical investor strategy, you can see we're up about 12% on that position. Now, this is a pretty straightforward bull market, bear market signals, tell you when to get in, when to get out. Overall, up fairly nicely on the markets here for that position as well. Now, we did have one other comment. We've had a member talk about how we're in this trade with the S&P 500 and the NASDAQ for that matter. If we take a look here, you can see the trades we've done this year. We've avoided the crash. We got back in. We played a nice 15% gain to the upside. We're back long, hit a target there this week. And this current trade, this member, we're in this trade, and they're worried that they haven't made back their subscription fee on this trade yet. We've hit our first target and they haven't made it back. And I just want to mention it, position size or portfolio size does play a role in people's positions. Some people will make their money back on the first trade, depending on your account size. Others may take a couple trades. Again, we're up in this trade. This one member says they haven't covered their subscription fee. My account on this trade alone on these positions with SPY QQQ is up over $100,000. I know we have a couple subscribers that are up over $300,000 and $400,000 on these small trades. There's some big money being traded with these. And of course, it takes money to make money. And if you do have a smaller account, and this is the thing with smaller account sizes, is you generally have to be more aggressive to get your account large enough to start being able to make some better returns, which is why people move to small cap stocks. It's why people use options and 2x ETFs. And so, for example, our ACS strategy, which you can see right here, if we take a look at our ACS strategy and look at the performance, we have very nice, strong returns each year, averaging about 13% or so. If you use a 2x ETF, you have potential to nearly double that. If you use a 3x, you can get even more. So if you have a smaller account size, sometimes you do have to use a little more juice to make things worth it or to make more money. And again, this is the service for our investing signals here. There's 5 to 12 of these signals every year. Very easy to follow. We have 1 or 2 ETF positions open at a time. It's just either we're long the stock indices, bonds, currency, or cash. So we have that strategy. And if you're interested in just the bull and bear market signals, which is the TTI strategy, it's up 12% since the last entry a few months ago. We have that as well. This is only $250 a year to know when to hold and when to fold them. And then, of course, we got the golden oil guy service. If you just want momentum, short-term trades for multiple things. If you take a look at what a sample report looks like, we cover SPY, the VIX ETFs, GDX, GLD, SILJ, SLV, USO, and Bitcoin, which actually we've changed this to IBIT because it moves a lot better with Bitcoin. So we have all of that. And of course, if you're an options trader and you're into options, we do have options trading signals if you want to. This is for more advanced options traders. This is for selling and writing options. And we have that as well. Anyways, hopefully you got some insight from the markets. Let's just let them continue to unfold and buckle up for Triple Witch on Friday, which is tomorrow.